everybody, it's Kevin Wadsworth at northstarbadcharts.com, and I want to take you through some charts today that are associated with paradigm shifts and that illustrate just how tricky a position we're in at the moment in terms of the global economy and what's occurring financially. So going through these charts one by one, and the first thing just to sort of point out is, that the charts have real-world implications for the global financial system, and as we go through them, just have a little think about the implications that they might have, and also the implications on political stability and the potential for increased tension and conflict, which I think is the most sobering part of all of this. Before we kick off, just a point here about questioning narratives. I often hear people say things on social media, Twitter, for example, but I heard something in a report by, I think it was UBS Bank, which was intimating that silver and gold prices are going to struggle because of rising interest rates. Well, one cursory glance at the facts proves that that is completely untrue. Not only is it untrue, but it's the total opposite of the truth. You only have to look at the 1970s, 1980s and 1990s to realise that. Rising interest rates took precious metals up, and falling interest rates, well, probably not quite true to say that they took precious metals up, because there's a whole load of other things that were acting to cause that as well. But certainly it's not true to say that if interest rates rise, precious metals can't rise, because that's exactly what did happen in the 1970s, and the opposite happened when inflation and interest rates came down. Precious metals came off their highs. So when you hear something, don't just accept it, don't just assume it to be true and go along with the narrative because everyone's nodding their head and agreeing. If you can't verify the facts, then don't place any value on them, really. Just because everyone's standing around nodding their heads saying, oh yes, that's right, doesn't make it true. You need to be absolutely sure of the facts before you start making any decisions based on those statements. So moving on to moving on to the global PPI indicators. These are pretty important because they're almost like a precursor to what's coming. The Producer Prices Index has been rising like a rocket for many months now, and I've been pointing this out repeatedly. And here's the chart for the European powerhouse, Germany. It bankrolls the European Union to a large extent. And you can see how the Producer Prices Index is way past what we saw in the 1970s, and it's now way past the peak that we saw there post-World War II during the reconstruction process that needed to be undertaken in post-World War II Germany. So what I'm trying to say here is that we're at truly historic levels by many measures. The charts, the indicators, the numbers are increasingly now getting to historic levels, which are going to send shockwaves quite literally through the financial system. I don't know what's going to break, but something's going to break at some point, I suspect. The 10-year yield points to that pain ahead. You can see that in the 1970s, the 10-year yield was rising and was supported by that black line there, the support line. And during that period, in the 1970s, a lot of turbulence, a lot of turmoil, a lot of industrial action, a lot of course, the oil shock and all the rest of it. It was a very turbulent time that historians look back at and reflect upon. Now, when we turned the corner in the early 1980s, the support line broke to the downside, and there was actually a higher support line that formed during the later stages of that period, and that broke down, and then the more shallow angled support line broke down as well. And from that point onwards, instead of having a support line, which was the main sort of line of significance, the main line of significance switched to being a resistance line, and all of the upticks in the 10-year yield were contained by what I've called the pain line. I've called it the pain line because as time's gone by, it's become clear that any move above that line is likely to cause pain, in inverted commas, in the global financial system, because that line is there as a result of not being able to comfortably move above it due to the debt due to the amount of debt that the United States has amassed. Paying interest on an ever-increasing pile of debt means that your debt payments to service that debt become ever more unmanageable, particularly in relationship to GDP, as debt to GDP has increased. So for a whole number of reasons, any prolonged period of time above that line is going to start causing cracks to appear in the financial system, and I think we're already starting to see that unfold in real time in front of our eyes. Now, this chart, I've perhaps wrongly called it the 10-year real yield. It's not the real yield, it's actually a 10-year yield adjusted for inflation. So the 10-year yield there around about 3% and inflation at 8.5% and rising. There's a bit of a mismatch between the figures, so don't take them too literally. There's a timing difference between the data and in the figures, but you get the idea that as yields are only around about 3%, I think it was 3% looking at that previous chart there, and inflation rising past 8.5% now, 9, 10%. In fact, the real inflation figure is probably more like 15%, then the actual real world yield, if you want to call it that, is plunging, not rising. So, you know, the yield is rising, the nominal yield is rising, but not at a rate that can prevent this inflation adjusted version from falling like a rock. That's important to bear in mind. This is a bit of an odd chart. It's the US dollar index versus inflation. And I've had some criticism for this chart because it's an index. The US dollar index is just a comparison between the US dollar and primarily the euro, but also the British pound, the Japanese yen, and one or two others. So how can you compare an index to inflation? Because that index is just fluctuating within limits. To the downside, 60 or 70 on the dollar index perhaps, and to the upside, 120, 140, 160. And the US dollar index is a number currently at around about 103. And that number is a reflection of how strong the US dollar is versus the contents of that index. So if you think about it for a moment, if the US dollar is strong against its peers in the dollar index, it puts the brakes on this chart from falling. Okay, think about that for a second. If the US dollar index is rising because the US dollar is relatively strong against the other currencies, then this chart will stop falling, may even rise a little. But at certain points in time, when that's been occurring, and there has been, the brakes have been put on because the US dollar is showing relative strength, it builds out, the chart builds out a consolidation pattern or a rising pattern. But each time those are bearish patterns. You can see 3 of them on that chart, and you know the US dollar index versus inflation was rising. Now when that pattern breaks down, it's because of a combination of high inflation and or a weak US dollar. And that particular point in time where those factors combine to break the pattern down occur at the start of precious metals bull runs. It happened right on the left-hand side of the chart there in the late 1960s and 1970s, although admittedly the US dollar index was far less valid than it is now. So really the first sort of period that you can be looking at there is the mid to late 1970s, where that consolidation pattern built out and the chart went up, and then it broke down in 1985. At that point, gold rallied around about 60% or so in a disinflationary environment. And the same thing happened in 2002, another breakdown where gold rose over 600% in a disinflationary environment. We now find ourselves in an inflationary environment akin to the 1970s, and the chart pattern is breaking down, which leads me to think that precious metals are on the cusp of an historic run. The Russian ruble is worth a passing mention here, or more than a passing mention, because the tensions, not call them tensions, it's a war that Russia started with Ukraine for whatever reasons you wish to assign, and whatever role the West played in provoking that, I suppose. The initial knee-jerk reaction, and I pointed this out at the time, it's a bullish descending wedge, and the knee-jerk reaction was a break to the downside. Usually, when that happens with a bullish descending wedge, it turns out to be a false break with a very, very rapid snapback in the opposite direction. And that's exactly what's happened here. The bullish wedge has held, and the true direction has emerged, and that is the ruble breaking out against the US dollar. This is the official rate, of course, and it's the rate that global central banks set, and it's it's associated with the trade that goes on between global central banks and Russia in terms of purchase of oil, gas, commodities, and all the rest of it. So, how much you might want to debate the validity of this chart, it is the official rate, and it has broken out. And from an official standpoint, the ruble is now significantly stronger than it was before they declared war. So make of that what you will. There's a time for equities and there's a time for gold, and this chart points that out very clearly, that we had 10 years during the 1970s where the SPX index went absolutely nowhere, and a period of 13 years during the early 2000s where it went absolutely nowhere. At that time, in the 1970s, where the SPX was going sideways, gold rose around about 1,000%, in fact, a little bit more than that. So it would have been very frustrating had you been invested in the general equities at that time. And eventually, as time goes by, people realize that and pile into precious metals, and that's what drives the final parabolic run up in precious metals. During the years that followed, the SPX began to move steadily up, and gold and precious metals generally went steadily down. That took us to around about the year 2000, and at that point the SPX topped, and it went nowhere for 13 years. It took well over a decade to reach new highs. During that period, gold rose 600%. So there's a time for equities and there's a time for gold, and that rotation gathers momentum, and finally people give up on the S&P, and the last sort of push of rotation into gold takes place, and then the baton is handed over back to the SPX, and those that bought into the precious metals late on in the bull run are left carrying the bag. So it's so important to spot these points in time where the baton is handed from SPX to gold, gold to SPX, and my suggestion is that that is happening at the moment. That gold, when it breaks out in the all-time highs, will be the official green light that the baton has been handed over. Although in reality, for the last 20 years, gold has been outperforming the SPX, and you can see we've been rising steadily since around about 2019, I think it is there, with a very steady rise in the gold price, the SPX gradually losing momentum. So looking more closely at gold versus the SPX, we have a multi-decade arc with multiple confirmations on that arc. The stock RSI, the technical indicator at the bottom, is rising. We've had higher lows on this ratio for the last 7 years. This has concerning implications because of just where the chart is pointing to and how much this how extreme this new shift could well be. So we're moved from an old paradigm of the SPX outperforming gold to a new paradigm of gold outperforming the SPX for years to come. This also applies to silver versus the SPX. You can see that on the chart here, the same sort of pattern building out. and the move from one paradigm to another. History is seasonal and winter is coming, said William Strauss from The Fourth Turning, his book, which was written about what's happening now and about how each generation has its challenges. And the fourth turning is now underway, as defined by his book there. If you haven't read it, it's worth seeking out. And yes, it's very concerning, I have to say, and very disconcerting to see these huge tectonic shifts that are taking place and the shockwaves that are going through the global financial system that I suppose the vast majority of people are largely unaware of, although they're starting to see the standards of living declining and the cost of living increasing, bills going up, inflation and that kind of thing. So as far as the man in the street is concerned, that's the manifestation of what's going on. And also when you switch the TV on and see the terrible scenes from Ukraine, that is also all tied in with this. And just how much worse this is going to get, as shown by the charts, is concerning, because we already have a very dire situation in Ukraine, and with what looks like just an acceleration of these events over the coming years, it does make you pause for thought. Okay, I'm going to leave it there from me for now. I wish you all well, and stay safe, and more as this develops over the coming years. Take care. Bye-bye.